What is up, you guys? My name is Aubrey and this is my channel, and today we're going to be talking about interest rates, and we're going to be talking about what it means whenever the Federal Reserve either increases or decreases the interest rates, and what that means for the economy, for the United States, and for you as a consumer. So let's get started. The discussion around the Feds or the Federal Reserve raising or decreasing interest rates is something that you see in the news all the time. We've been hearing a lot about this now with the pandemic and the fact that interest rates are at an all-time low. But even whenever the economy is good, we still hear the discussion of interest rates quite often. In fact, in the last couple of days, we've been hearing kind of more about it because of the fact that the Federal Reserve has stated that they're going to be keeping interest rates at an ultra-low rate. But then this begs the question of, what does this mean? What does it mean whenever the Fed cuts rates or raises rates? What does this mean for the US economy? What does this mean for the world? What does this mean for you as a consumer? And so that's what I want to get into today. But before we can get into that, you first have to understand what they're referring to as far as rates go. And with rates, what they're talking about is interest rates. So basically the cost that you are paying as a consumer in order to borrow money. We oftentimes hear about interest rates being talked about in the context of credit cards, car payments, mortgages, and things like that. And whenever we're talking about this on a much broader scale when it comes to the Federal Reserve, it's the same thought process. Whenever we say that the Fed cuts rates or raises rates, we are referring to just that, interest rates. The next question is, who decides to cut or raise rates, and what does this mean for the overall outlook of the economy, and what does it mean for you as a consumer? So whenever the Fed decides to cut rates or raise rates, this is a decision made by the FOMC, also known as the Federal Open Market Committee. And in its simplest form, the FOMC is a policy-making body for the Federal Reserve System, meaning that they are the policymakers for essentially the branch of government that controls our money. Now, whenever the FOMC and the Feds change the interest rate, they aren't requiring every bank and every lending institution to adhere to this new rate. Instead, the new rate that they change it to is oftentimes simply just a guidance, and it's a guidance on a much broader scale. You see, the Federal Reserve and the FOMC, they don't control private banks. They don't control small lenders. They don't really have any say in what these banks and lenders and small banks do with their interest rate and with their borrowers. Instead, they control the interest rate on a much broader scale. They control the rate in domestic and international funds, and as a result, that rate then trickles down to us as consumers. And even though the FOMC and the Feds don't require for smaller banks and private banks to adhere to that same rate, more often than not they do. So as the FOMC and as the Feds change the rate on domestic and international funds, we also see the impact as small-time consumers. So now that we know what it means to change the rate, we know who changes the rate, now begs the question of, why do we change the rate? And the answer to that question is that the rate changes in order to accommodate to the current economic climate. For example, whenever the economy is doing poorly, interest rates are historically lower, whereas if the economy is doing extremely well, interest rates are historically higher. The reason for this is that if the economy is doing poorly, then people are more likely to hoard onto their cash. They're less likely to spend money, they're less likely to invest, and they are more likely to save. And saving money is not good for the economy. When it comes to growing and improving an economy, saving is not good for that purpose. So in order to combat this, the Feds will lower the interest rate, and this encourages people to spend more money, it encourages people to borrow money, and encourages people to invest money rather than save it, because in their savings account they don't have a good interest rate, so they are better off investing that money instead. This helps stimulate and stabilize the economy, and it helps encourage consumer spending. In fact, we are seeing this exact practice in action right now with the current economic climate that we're experiencing. The Feds have set the rate at between 0 and 0.25%, meaning that you can borrow money and potentially pay no interest, or at the high end, 0.25% interest according to the Federal Reserve. And this is a really great way to encourage spending and encourage borrowing, and this in turn helps stimulate the economy and improve the economy overall. While on the flip side, if the economy is doing extremely well, like what we saw between the years of like 2010 and 2019, then you will see the exact opposite happen, and the Federal Reserve will increase the interest rate. And you may be asking yourself, what's the point of increasing the interest rate? All you're doing is punishing consumers for doing exactly what they were encouraging during the economic downfall. And in a way, you're right, and in a way, I agree with you. I wish that overall we could just keep interest rates at an all-time low all the time. time. But unfortunately, the economy does not work that way. But the reason why the Feds raise interest rates during strong economic time periods is to control inflation and to also stabilize the economy with stabilized growth. You see, the process of raising and lowering interest rates really is a game of like teeter-totter and trying to find that nice equilibrium where things are nice and even. A too high interest rate is bad for the economy, but a too low of an interest rate signals that your economy isn't doing well. So you really do want something in the middle where you can get an interest rate that borrowers can make money off of, but one that still encourages consumer spending. And so it really is a fine line between finding that middle ground that works well for both lenders, but also borrowers as well. But with it being said, you guys, this is my simplified explanation as to what it means whenever the Feds cuts and raises interest rates and what this means for the country, for the economy, and for you as a consumer. I know that for me, this was something that I always found confusing, and I didn't really ever fully understand it until I was in my early 20s, and so I thought it would be helpful to a number of you who may feel the same way. But make sure to leave a comment down below, and while you guys are at it, make sure to hit that like button, hit that subscribe button, and hit that notification bell, and I will see you guys in the next video.